All right, another one of those days where no introduction's really needed. We know what happened today. The question is now what's going to happen the rest of this week. How big of a deal was it today that we dropped so far down to another important key level at 2600? That's what I'm going to break down, as well as the trade idea on a stock. Actually, quite a few advancers that we had today compared to what we've seen before. So let's go ahead and get started. Today is Monday, October 29th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those of you watching us for the first time. Subscribe to our YouTube channel. Mouse over this logo right there, then click that red subscribe button that pops out. That will notify you when these videos are posted. Also, click the thumbs up icon down below the video. That tells me two things. Number one, you got something out of the video tonight. Number two, you want us to do it again tomorrow. Quick, easy way to give us feedback. You can do that right now while you're watching. Also, while you're down there, comment on anything that stands out to you or questions you have from tonight's Market Outlook. Join our daily Market Outlook email list. You can see there's a link popping out in the top right corner of your screen. Click that link to subscribe. Follow me on Twitter for more content like this throughout the day. And join our Market Outlook community that we created on Facebook. All right, well, let's start off by taking a look at the S&P 500 with the market forecast indicator. Interestingly enough, you can see, of course, the intermediate posture is still bearish. And keep in mind, getting the intermediate line down to 12.1428. Let me just show you something here. All right, you can see the time that we've been this low before. I've set the chart to only show the intermediate line. The horizontal, this is the last 10 years. This is the horizontal line. And all the times that we've been lower than where we're at right now, which you notice 1, 2, 3, 4, 5 during this chart, every one of them with a cluster, and you can see on the chart where the cluster occurs and what happens generally after the cluster. And this was early 2016 with the divergence there on the intermediate line, and then there on the November. And if I were to zoom this over a little bit more, you can see some more instances of it being below where we're at right now, all with clusters, all with significant lows. There's the 2012 pre-QE3 divergence, and see every single one of these. And you can see also that every single one of them, the intermediate line turns up and gets up above 80 almost every time pretty quickly. See that, how it goes up above 80 almost every time from, here's one that's close, from these low levels. You see when it gets this low, there's another one where it gets right up to 80 and right up to 80. And this one with the divergence in 15 and then in 16, and then boom, up to 80 each time. And this one up to 80. So you can see how quickly the market recovers when the intermediate line gets this low. It turns up to 80 pretty quickly. So we'll see if that ends up being the case again this go around. Of course, we've already got the cluster, and that was on the initial surge. And you can see the near-term line, the blue line, dropped down again today. Not surprising, down day last 2 days. But because we have long lower shadows in 3 of the past 5 days, we're not able to close at the lows. In fact, 4 of the past 5 days, we're well off of the lows. Really, it was only this day that we closed at the low point. Because of that, you notice the near-term line has not. This is the low. This day right here is the lowest point that the near-term line's gotten, even though we've gone much lower in the past 5 days. But because we never finish at the low, except for once out of 5, we end up with the near-term line that's actually rising. So that's obviously a divergence. There's the more recent one. So there's your low point that we gradually get higher, and then of course with the orange line we're gradually getting lower. And then, of course, again today. And as I mentioned on Friday, we typically, and I also mentioned it too in my, well, here, let's look at these charts here really quick, and then I'll show you what I'm talking about. There's your Dow Jones Industrial Average, looks very similar. They're all going to look very similar because when you're going down, the correlations get close to 100%. You can all see the divergences in the blue line and the oversold intermediate lines, and you can see the doji again. On the kind of a Harami doji on the Russell 2000. All right, just a reminder, wanted to remind everybody watching our Market Outlook on the blog, there's our schedule for our classes tomorrow on Halloween there on October the 31st. Remember, you can also participate in our forums. You click on this link, it takes you to our forums. So we have forums for all of our classes, as well as you can see the market outlook there. You have to subscribe. You have to click this icon right here to join and subscribe. You can do that right here for free. Just fill out that form and hit sign up there. Also, we look for, we want to see your feedback on whether, you like our video and what, that you want us to keep doing these. And the way you do that is 3 clicks. One is to click this heart for tonight's Market Outlook tweet. Just click that like button when that window pops up. Click on this image that takes you to your Facebook page, where you can click on like and like today's Market Outlook post there. And also you can do it on our blog right here. So we get about, about 1,500 views on Fridays, and that's how many likes we got. So again, we kind of look at that number to see, if you want us to do it, just click on one of those 3 things or all 3, and that tells us that you got something out of the video today. All right, so we look at the long-term chart. You can see we're still below the 200-day moving average. Remember, according to Ryan Dietrich and the studies that he's done, the stats he has, the most volatile days occur when you start the day below the 200-day moving average, as we are. Now, that doesn't mean we'll finish the week below it, but as of right now, we are starting the day below it. We'll have volatile up and down days today. Don't get too worked up about the big swings intraday. I also wanted to talk about in my class, and I think I might have mentioned this in the Market Outlook over the weekend, but in the technical analysis class that I taught, the Market Scholars technical analysis class, we talked about this idea that when you have these big sell-offs, we don't get the reversals without a long lower shadow here, usually on a weekly chart, to a new low. So for example, in this week, you got a long lower shadow, obviously a much lower low that we came up off of. Then you have this low point on that week. You got a relatively long lower shadow to a new low that you came up off of. And again here, long lower shadow on these really volatile times in March and April and February. You can see, another one here on that dip. Some of these dips aren't below the 200-day moving average, or weren't really significant. Some of these, you notice, new lower low we came off of, new lower low again, with a long lower shadow we came off of it. You can see the same thing here, new long lower shadow to new lower lows before you come off of it. So when you get these sell-offs below the 200-day moving average or through it, you typically have to get long lower shadows without it. In fact, one of the only times we didn't was the election. That just happened to be, we finished the week before down, and we had the election the week of. So no long lower shadow. In fact, the long lower shadow occurred overnight, right, on ES, on the futures contract. There's your long lower shadow on the futures contract that week, because of how bearish things got overnight. So that's the concept. And the concept behind that, the psychology behind that, is you have to have a significant change in sentiment from extremely bearish when things are tanking like they were today when we hit 2,600, like nobody in the world wanted to buy stocks or touch it. I mean, you have to get the consensus to the point where nobody wants to touch stocks or buy them. And usually intraday or intra-week, that's where it has to occur. And then it changes, right? Then you get the big jump higher, and that's where the long lower shadow. So for example, here we opened up at 27 or 2680. We hit 2603 at the low. That's if we were to finish higher, say above 2700 this week, which would be significant. That would mean that we have a fake out breakout, below that 2700 level. Then that would be about an 80-point lower shadow, and that would be significant here, and it would be to a new lower low. And earlier today, nobody wanted to touch stocks, and again, it has to be consensus. You have to get everybody on one side of the market before you get the reversal pattern. And same thing over here. When you get everybody on one side of the market, it's usually when you get the reversal in the other direction, right? And so we might see that this week because of today's intraday drop. We from 2680 down to 2603, and because of how bearish we were in the new low, that long lower shadow to a new low might be this week. It might be next week. Who knows? But we can't reverse and hold the reversal until we get that. You look at the 3 green arrow chart, and you'll notice that, of course, 3 red arrows. And if you look at the, if I were to put it on the 2-line versions, you can see that MACD is getting, extremely low. The stochastics is not getting very much lower because it's already very low. And you can see the orange line is dipping below the 20th percentile, which is rare, similar to the intermediate line, which is rare for it. You can see again how far below we are, not only below the 8-day moving average. This is actually what measures the 8-day versus the 17-day moving average. But if I were to change that MACD and look at how far price is below the 30-day moving average, the blue line up there is 6-week moving average. Again, we are about as low as we were back here at the worst part in February. So very, very significantly low there, for the S&P 500. And really, if I were to take a look at, again, kind of go back to the MACD here and show how far below the 200-day moving average, which we haven't been below the 200-day moving average significantly for a while. There it is. And if I were to go back 10 years on this and keep it on the daily chart, again, you can see that's the last time we were this low, and we were stuck because of the death cross of the 1040. We were stuck that low for a while. Every other time, we only dipped a smidgen below before rallying. You can see back here, 2011 was another time where we dropped below 200 and stayed for a while. Other periods pretty shallow. This would be similar. We're at 114 right now. This was a similar drop. We only got about 80 points below. But you can see when you get about this far below, and these were much bigger numbers. 128 on 1200. That's a 10% drop here in 2011. We right now are at 114 on 2640. That's not 10%. So keep that in mind. This is an absolute figure, not a relative figure. So we are, even over here, if you take a look, when we are, 170 points and 170 points over here, that's of 189, 187. That's almost 10% there. Again, we're not close to 10% right now. So while it seems as deep, it's really relatively shallow because of how high the S&P is right now compared to that absolute figure there. All right, when you take a look at the intraday chart and you can see the dip, and really, when we fell off the cliff at the end of the day, I happened to be actually with my 10-year-old x-raying his finger. He broke his finger in our championship flag football game last week. But while I was watching and waiting for the x-ray, I was watching this occur, and then we hit that low point again. And also watching the reaction on Twitter, because again, I need to see everybody on one side of the market, even the most bullish people, to be on one side of the market. And you can see the late bounce we had of about 4 points. It looks really small because of how big the dip was. It was an 11-point drop from high to low. And again, just a reminder, we are 30-plus point, 34-point range on a 293 high. Again, above 10%, which is an extremely wide range for a 4-week range on SPY. Very, very, typically very bearish. But I mean, typically, again, very extreme. One of those contrarian extremities that you look for. If you take a look again back at the range today, 100. Let's go to SPY so we can see it. 10-point range. And the volume at 100, and see less volume today than what we had on Friday. So when you put that in context here at 160 million, that is off the charts, but right at the very top actually. 10-point range, well off the charts. That is, almost 4 points. It's over 3, about 3 points, or between 3 and 4 percent. And the average right now is up to 2%. Again, about as high as we got before here. So. And you can see even the absolute ATR now up to almost 5 points, again about as high as we got. And again, relatively speaking, how high has that gotten before? It's gotten higher. You can see 5 points there. And again, remember, these are all relative numbers. This was 4 points, but we were on 200 or just under 200. So that's about, 2%? That's how high it got there. Well, you can see it right there. I got about 2%. So this is the relative ATR, right? How high it is. So we are getting about as close 2%. Is that 1% is the kind of the key mark. when you're below 1%, you're bullish. When you're above it, you're bearish. 2% is about the extremity, and we're just about there, and probably will be there because that ATR will be up here for a while because of how high these past few ranges have been, because it's a 14-day. It'll take a while for this to come off. If you look at the volatility, it's interestingly enough, volatility did not get up to a strong new high. It didn't get up above the high from earlier, from a few weeks ago when we first dropped. And the relative VIX compared to VXV did not get above 1.15 again. Again, we had that initial surge of volatility, and we're still above the extreme level, but not an excessive surge of volatility. It's high. But we've seen the excessive surge. We've come down the support. Now we're high again. The expectation is that we'll moderate again. We've seen this before. We saw it earlier in the year, and you would expect to see it again. There's your excessive surge over again. Eventually here, I might have to go back a little further. Let's go back a little bit further. That 360. 1 second here. There we go. There's your excessive surge that lasted a lot longer than this one did back in January or beginning of February. And then we came down and we had a period of high and extreme here at the end of March. So the gap between was long. The initial surge was longer. The gap between was longer. And we had this period up above 20. So here the initial surge was actually smaller, especially on a relative basis. The gap between was shorter because, again, we're seasonally bullish time of year, and you can see where here's the high phase up above 20, similar to this one and that we saw back at the end of March. One more thing I did want to show you too, the RSI, for perspective, just how bearish we are. The RSI, 30 level is pretty deep, and we got pretty deep before below 20 on the RSI back in 2015. You saw that divergence there, and then we barely got below 30 in this break. And remember, this was the death cross. We were below the 200. The 50 was below the 200 in these areas. All these other times that we were in bull markets, we never did get below 20. Here we got below 20 and on the credit downgrade. This is very, very similar kind of a drop in terms of speed and getting below lows as we saw on the credit downgrade. And again, there was your lower low that ended up being the period that nobody wanted to buy in October, incidentally enough. Well, here is our deep drop below 20, which is so rare. That's how fast and sharp it was. And then now we're actually diverging. This was also very common after you get a big surge. And it's actually really common on any. There's your divergence there. It's pretty common to get these divergences to the upside and the downside on the RSI, and we're getting a pretty decent bullish divergence right now. Another common oscillator is the CCI. Again, it doesn't drop this far below the negative 300 as often. We've seen it a few times back here in August, and you diverged there. You saw it over here in February, again in March. There was one here on that dip in late June. So here we are again below this kind of 250 down to 280, and we're diverging big time on the CCI, which, again, is very common when you get this big surges like this. If I were to zoom out, you can kind of see when we get these big surges and the divergences on these significant low points. So you can see them all across the board and just how bearish we are now compared to where we've been in the last 10 years. So again, another one of those technical signs that, and of course how important 2600 is. 2700 is that key fake out level, right? If depending on how we end up this week, it depends upon whether that breakout actually is a breakdown. And then of course 2600, where we hit this morning, is the key level because that's your last market sentiment low point. You break below that on the orange line of the market forecast, now we've got new lower market sentiment lows, which we haven't had since 2007, 2008. Of course, that to me is a bear market, right? When you're getting new market sentiment lows, now we're in a bear market. 20%, I wouldn't constitute a bear market, not until you get to a new market sentiment low point. We are coming down from a higher high point on the market sentiment line. So that being said, to summarize, again, obviously there's a lot of extreme contrarian type indicators in terms of this sell-off. Is today the day that we got that new lower low point where everybody joins the perma bear, so to speak, on one side of the market at the low of the day today, especially heading into a very important support level, and especially with all these significant divergences across multiple indicators that are showing up. Significant divergences because of how deep the second leg has been. So that's, the expectation is the bounce coming out of that. And so, we've seen it before. That would be the expectation. Again, it would be more the expectation the more we get people clearly onto one side of the market. In this case, would be the bearish side. And that could have happened today. So what do you think? Do you agree with that or disagree with that? Click that poll right there, top right corner of your screen. Hit either agree or disagree. If you click disagree with that, scroll down to the bottom. Let me know what you're seeing, what your posture is, and what based on what you're seeing on the charts. And even share with the community what you're seeing that gives you that particular posture that disagrees with what we're seeing here with the market outlook. All right, one more thing I wanted to look at before we get into what's driving the price action today is this advanced decline. This is the amount of advancers relative to the total issues in the New York Stock Exchange. So 50% means we have more advancers than decliners, which we did not have today. We're at 42% though, which is a higher number than what we had on Friday. So we actually had more advancers today than we did on Friday. In fact, we've had more advancers today than we did on Friday, than we did on this day, on the 24th, where we closed at the low. Even though we're at lower levels, we had on that day, even on that day, that was the day where we had the fewest, we had 10%. So right here on this day actually, we only had one advancer out of 10 stocks for nine decliners. Today we had 4 advancers and 6 decliners, and we're on much lower levels, seemingly much more bearish tone than what we had there. So again, you can kind of see we're losing the bearishness as we get lower, and we're getting more advancers day by day, which means that the buyers are they're making a push. Like I mentioned, 4 out of the past 5 sessions were well off of the lows, which means the bulls are coming in at the end of the day, and each of these days, all except for the one day out of the 5. All right, now if we see the price action, you can see the small cap, the IWM and U.S. stocks were the biggest winners today. There's your developed markets, there's your emerging markets. Stocks were really up early, and obviously they pulled back. Emerging markets pulled back the most. In fact, by the end of the day, emerging markets, crude oil, growth stocks, commodities all had the biggest drop, anything commodity related. On the other end of the spectrum, look at value stocks rally today. Preferred stocks, dividend stocks up today. With bonds falling and yields rising, which is not very typical to see dividend stocks rising with those yields. And you can see real estate coming up off of low levels. The dollar ending up today, after everything, ended up today with the worst, with the best performance. You can see crude oil started the day down and finished the day relatively down. Same thing with these other commodity prices. So it was a sell-off day, but it wasn't right at the very beginning. It was all throughout the day. And of course, if you look at the last 10 days here, the last 2 weeks, you can see the dollar continues to be the strong performer, along with gold, and as your safe haven trade and preferred stocks holding up there. But then there's your all your equity asset classes in crude oil, all still stuck down at pretty significant lows. And if you recall again, from a U.S. stock market standpoint, which is right there, some of these didn't, you can see Mexico really dropping sharply, 7% down today. Brazil, another American ETF, down 3.5%. It was one of the bigger winners. And then, of course, Argentina down 2%. So South and Central America really getting beat up. China, Indonesia down with Korea. So there's your Asian emerging markets all getting beat up the most. On the other end of the spectrum, India holding up, as well as European ETFs kind of holding up there. So if you take a look at these foreign markets and how they're performing relative to each other, whoops, not that one, this one here. That's the next 12, right? This would be the next 11. This would be the biggest 12 economies. You can see, some of them getting down to new lows on an intraday basis, some of them not. So it was a relatively bearish day for some, but trying to figure out. You can see Korea was the only one with an oversold cluster today. China getting a new low, new intraday low, and again, that's going to be the big key. Are we going to get the intra-week lows that give us that long lower shadow this week? And again, here's the weekly chart, and you can see all the clusters in the weekly chart so far for the week too. Lots of clusters all across the board. And again, as you've seen before, when you get these clusters, as we saw in early 2016, that was your reversal sign for these international markets, and it was the international markets that led the way higher for the U.S. markets in a really good 2-year period. 2016, 2017 was a very good 2-year period, as you can see right here, for the S&P 500. Here, if I were to draw this from the low up to the high of 2018, it was a year where we had a 30% annualized return over 2 years practically. 30% for average for both years. And again, emerging markets and developed markets leading the way for that rally. And we are as oversold now in those areas as we were back in early 2016 when we were coming up from that death cross. At least relative, not necessarily on an absolute level in terms of percentages, but according to the oversold clusters you see on that on the weekly market forecast indicator. Now, if you take a look at the beginning of the day, you had communication services, technology, consumer discretionary, and financials all bounced early. They had the biggest gains early, and that reinforces what we've talked about before is when the markets bounce, they will be your biggest bouncers. Typically, they're some of the biggest losers, but they will also be some of your bigger bouncers as we move higher. Now, of course, the biggest losers over the last 3 months has been energy, materials, and industrials. And there's those three kind of all three of those in 10% levels. So they bounced up the most today. By the end of the day, you can see they were your biggest losers. Technology dropped, communication services dropped. There's consumer discretionary. You can also see industrials and energy down, lagging the market down, materials outpacing because of those metals, those gold stocks. And then by the end of the day, your best performers were staples, utilities, and real estate, your safe haven areas. Healthcare also finished the day with a gain. So not everything was down. You had some areas of the market that were up, and you still have two areas that were up in the last 3 months with a small loss in real estate. So, again, safe haven areas hold their value better during these declines, and we're not even in that one of those bear market declines where we got the death cross, where we expect the death cross to last for multiple months. That's not the expectation right now, at least not yet, where those really hold their value the best over such an extended period of time. You can see during the last recession where the stocks were down 50% from the death cross in early January of 08 to the low point in March of 09. Materials, industrials, financials down the most, but you can see with the markets down 50%, healthcare was down 35%, staples was down 30%, and you can see utilities down 45%. So utilities, for the most part, held their value until a late decline right there at the end. But you can kind of see from a 20 to 30% drop when the market itself was down 40%. So they will hold their value, and staples really held their value well. Those are where your dividend stocks are. They will hold their value best during those declines. And it was really during the big declines late as energy and materials usually lead early, right? Lead the way. I mean, they were still up 10% or more, more to about a quarter of the way into that bear market where we went to new lower lows in the market sentiment lows, and the 50 had crossed below the 200 and stayed below the 200 for this whole time frame. One stock in those safe haven areas that's doing really well. Remember, not all stocks went down today, especially those dividend type stocks, staples areas. Pepsi, you can see it's done this quite nice little turnaround after coming down the lower lows, getting back up above the the moving average here in between the Bollinger Bands and starting to trend high. In fact, all three lines trending higher. Trying to clear an important layer of support here at this volume node, right about 112. We cleared up that today. You've got some important support right about 110. Your next big volume node is going to be a big layer of support there. We had broken down below that. We retested it here as a resistance, fell down again with this divergence, and then back up through it. So kind of a fake out below that 110 area, and we're back up. So a good sign from that perspective. When you look at some of these other charts, you can see the intermediate line turning higher, getting to a higher level than what we saw here, which is a good sign for it. From a long-term chart, look at its 15-200-day moving averages starting to cross back up with today's break. There's your fake down below in a morning star candlestick pattern below that 110 area. Then, of course, if you look at the DMI version here, Pepsi, you can see the orange line dipping back below 20, making with a move on 20 on this level, on the positive line back, staying above 25. So good divergence, good gap there between the directional index, the positive and the negative directional indexes. When you look at the 3 green arrow chart, you got 3 green arrows. Moving average hasn't started to turn higher yet, but when you look at the 2-line versions, you can see the 8 and the 17 are starting to cross the 30, which is a good sign for a divergence to the upside to occur after convergence coming up from a low. So of course, right now you don't want to be too aggressively bullish. Not quite yet. There's going to come a point where we want to be aggressively bullish. I'll talk about that in tomorrow's directional option strategies class. But as of right now, not quite yet. So we can look at selling this 110 where that strong support is, buying the 105, getting a decent probability of success here, right about 62%. And you can see where that break even is on the chart. Right below that important support level at 110. So, and right at this old high point, lots of touches in this area where that break even is. So opportunity to get into a decent trade. Remember, we're trying to make 122, so we're willing to lose 122 if it goes down direction to the downside. And that's where we'll cap our losses off if we get that far below. You can see you'd have to really break support to do that. And then if we can get that first half pretty quickly, then let's take that first $60, $61 or so, so we don't have to wait for the other 60, which you can see takes a lot longer to get. All right, so that wraps us up for tonight. As always, thank you very much for watching tonight. I appreciate it. Appreciate your time. I remember Brandon will be on tomorrow night, so be sure to check in for that. Subscribe to our YouTube channel. Click the like button, the thumbs up icon down below the video, and comment. Also remember to follow me on Twitter for more content like this, and join our community we created on Facebook, as well as our forums on marketscholars.com. Thanks again. Have a great rest of your evening, everybody, and we'll see you all tomorrow.